Welcome investors to my channel, to Fiscal Voyage. My name is Felix, and this video was suggested by Ike. Ike wanted me to do a stock analysis on waste management. So thank you, Ike, for subscribing to my channel and leaving a comment and suggesting me to do a stock analysis on waste management. And if this is your first time visiting my channel, make sure to hit that subscribe button and also leave me a comment of what stock would you like me to cover next. But before we start with the stock analysis on waste management, I actually did a stock analysis on waste management in August of 2018. And let's look at that right quick first. All right, so here's my past video on waste management. On August 2018, I made this video here, and the stock price on August 21st, 2018 was $90.82. My fair value price was $97. And so basically the company was undervalued by 7%. If we go to, so I had a hold recommendation, and the reason for that was because the valuation wasn't in my margin of safety, the 10%. If you didn't purchase waste management and the price actually came very favorably, so let me find here the day, the 21st, so this is the day I made the video, and as you can see here, the price was basically flat. But it reached to a point when it got as low as $87. If you would purchase at $87, you had a 11% margin of safety. And in December of 2018, it got as low as $83.70. That would have gave you a safety margin of 16%. So I had that whole recommendation for the price of $90 because the fair value undervalue valuation is only 7%. But using the fair value price, we had opportunities to buy it at a more favorable price, around $87. Anything under 90 really would have been good. But let's continue with the stock analysis on waste management and see if the stock is a good buy today. Okay, let's start with the updated stock analysis on waste management. The company basically is what the name is manages waste. Is an American company and a comprehensive waste and environmental service company in North America. The company's network includes 346 transfer stations, 293 active landfill disposal sites, 146 recycling plants, and 111 beneficial use landfill gas projects, and 6 independent power production plants. Okay, let's look at the fundamentals for the company. Waste Management grew revenue at a very low rate at 2.4% from 2010 to 2019. And then in that same 10-year period, net income had a much better rate at 6.4%. And currently the company has a great credit rating of A-, and operating income grew at 2.4% in that 10-year period. Earnings, however, grew at a much better rate at 8.6%. However, on the bright side, Waste Management over the past 5 years has done much better than the past 10 years. For example, revenue for the past 5 years grew at 4.5%, almost double the 10 years period, and net income grew at 22% in that last 5 years. So that's been an outstanding growth there for the past 5 years. And earnings in the past 5 years has grew at 14%, slightly less than double than the 10-year period. So earnings and net income and revenue grew quite nicely over the past 5 years. So let's continue with the fundamentals. For 2019, the company earned $4.40. Net margin came in at 10.8%, which is less than 2018, 12.9%. So it is compressed, but it is much better than the previous years. They were averaging in the mid single digits. So net margin came in better for 2019. And also for the first quarter, net margin was slightly higher as well. So that's a bright side there. Return on equity at 25%. The company tends to average around 26% over the past 5 years. Currently, the company has a very low dividend yield considering the 5-year growth rate is only 6.4%. So that current yield of 2.13 is quite low for this low growth rate over the past 5 years. However, the dividend is very safe at only a 60% payout ratio, and this is based on 2020 expected earnings, which has dropped, of course, because of the economic shutdown. And I'm not sure how really. I guess with the restaurants being shut down, the trash that they create, they no longer have trash to be picked up and things like that. But still, earnings for 2020 is expected to be lower. We'll talk about that shortly. And the company has been growing dividends for 17 consecutive years. So their dividend growth record has been very solid. So 17 years of growth. They have a nice 6.4% average growth for the past 5 years. And the most recent increase was 6.3% in December. So I'm expecting another dividend increase in December of this year. However, the charter rule gives us a 8.5, which is much lower than the 11, 12 I like to look for, which is the dividend yield plus the 5-year growth rate of dividend. So we have an 8.5, so that's much lower than the criteria that I have. And also something to consider, the 5-year dividend yield average is 2.22%. And currently the company has a 2.13% dividend. So this means that the current dividend is much lower. I want to say much lower, but it's lower than the 5-year average, which might be a good indicator that it may be overvalued at current prices. But we'll continue with our stock analysis and determine that. Let's look at the balance sheet for Waste Management. The debt to cap is at 64%, which is not great, but it's manageable. And the current ratio is at a good 1.84. You like to see this at 1.5 and higher, so they have more asset than liability, so that's good there. Currently, the debt equity ratio is at basically 2. That's okay. You like to see at 1.5 and less, but considering that their current ratio is pretty good, so the debt to equity is okay, and they have a good coverage of their interest at 5.8 times, so that's good there. So I don't see this company, going under bankruptcy. Considering also everyone has trash and we need someone to manage that trash. So Waste Management has a great business model. Let's look at the price to book ratio at 6.41 currently versus the 5-year average of 6.02. So this may be an indicator that may be overvalued based on its book value. Let's look at the future outlook from analysts. For 2020, they're expecting earnings to come in at $3.69. For 2021, $4.11. And for 2019, they had $4.40, like I mentioned. So 2020 earnings is 16% less than 2019. So of course, with the economic shutdown, that's dropped earnings. But as you can see, for 2021, they're expected to increase that to 4.11, but it's still less than 2019's earnings. So that's something to consider. And analysts, CFRI, expecting 5% earnings growth for the next 3 years. A lot of analysts in Yahoo and FastGraph, Yahoo expects about less than 1%, and same thing for FastGraph. I think it's about 2%. And here's something negative here. During using the dividend drill return model, projected total return is 8.2%. I like to see this at 9% or higher. So there's a red flag here. And another red flag also is the current PE is at 25 and the forward PE is basically 25, which the forward PE, I used the 2021 expected earnings to get the 24.9, and the 5-year average is at 24.7. So it looks like it's slightly overvalued based on the PE as well. And the thing to consider also is because of the PE and the potential growth of about 5%, that doesn't look attractive. If I was getting the PE of 15 with maybe 5 to 6% growth, maybe a little more attractive, but over here it looks to be overvalued. But let's look at the fast graph. The black line again is the monthly closing price. The blue is the normal multiple of 22.2, and the orange is a earnings multiple of 15. As you can see, the company from 2013 to 2018 was doing quite well, and actually to 2019. In 2014, it had a 15% earning growth. 2016, 11%. 11% as 2017, and then it jumped by 30% in 2018, and then 5% last year growth. So the company was growing earnings quite nicely, and as you can see, the price was increasing as well because of those earnings growth. But of course, as you can see for 2020, earnings is expected to be negative 16%, but picking up at 2021 at 12%. But because the price has been quite high because of the past earnings growth, it's kind of like the price went higher than earnings. Future total return is expected to be only 2.4%, so that's not very attractive. As you can see, the blended adjusted earning yields at 3.96%, so that's much lower than the 6.5 criteria of or higher that I like to look for. So at 3.96, adjusted earnings yield is not attractive at all. And as you can see, the black line is over the both the orange and blue lines. So that's based on the fast graph. It looks like it's overvalued. So let's go ahead and look at the fair value prices from the different analysts. CFRA has a fair price of $94.08. Morningstar at 81. Fast graph, as we just saw, $91.45. And this $91 is based on 2021 expected earnings with the PE of 22. So just FYI there. Yahoo at 110, and my dividend discount model analysis at $79.17. For this analysis, I use a 7% dividend growth for the next 3 years, which is quite slightly higher than the most recent increase. And considering the economic shutdown and they just purchased a company, I don't think they're going to be growing dividends at that pace, but I'm using past history growth for that. But I do expect him to grow dividends at least 5 to 6% going forward. And I use a discount rate of 9%. That's how I got $79.17. Averaging out to 5, we get a fair price of $91.19. Currently, the company goes for $102.60. Thus, we have an overvalued company at 11.1% compared to this fair price. So Waste Management is a great company. However, I have a hold recommendation at current prices. So as you saw, I have a hold recommendation for Waste Management. The only reason is a hold is because of the valuation. The company is great. I've actually had this company in my watch list, but I've never pulled the trigger yet because it tends to be overvalued, and the growth rate is not as attractive for the overvaluation. I like the 17 years of dividend growth, which is good. It beats inflation with about 5 to 6% growth rate over that period. So I like that a lot. The company has a solid balance sheet, so it's very a defensive stock in the sense that we all have waste that needs to be taken care of and disposed of properly. So waste management is a business that I see for the next 20 years or more because we're always going to have waste. But this is one of those stocks that you have to be patient and purchase it at a fairly better price than 11% overvalued. And as you just saw from my previous stock analysis, it was slightly undervalued, but then it presented a better opportunity where we had almost 16% undervaluation based on the fair price. But right now, again, we have a 11% overvalue, so that's why I have a hold recommendation. So thank you again for watching, and if again it's your first time watching my channel, make sure to hit that subscribe button, and I'll see you guys in the next video.